We're chatting about your global feeder fund this evening, and I'm going to ask you to tell us what you're offering us here.
Well, the Global Feeder Fund is basically a feeder fund whose only asset is an investment into our global fund, which is a Guernsey-based offshore equity fund. So it's a global equity fund which runs against the benchmark of the MSCI World, and we manage that here from Cape Town. It's a stock picking fund, and we buy stocks just like we would buy in South Africa.
In terms of risk, this is higher than your global balanced fund. Is it for the somewhat aggressive investor out there?
Well, it is an equity fund, so you are taking equity risk when you invest in the fund. So from that point of view, it is higher risk than a multi-asset or a balanced fund, the RECM Global Flexible Fund. It would be higher risk than that because it is an equity-centric fund.
Piet, can you give us some idea of the process that you follow in order to select stocks? I mean, when you look at if you look at the major holdings, these are typically the global multinationals that are. Is that the idea about this? It's really a global multinational fund. What is the process in how you populate the fund?
Yeah, that's a very good question. Basically, we start with a clean sheet of paper, and we look for good quality, undervalued situations. At the moment, and over the past year or two, these situations tended to be global multinationals, mostly domiciled in the USA, sometimes domiciled in Europe. The very large or large capitalization companies, in our opinion, had and have become very undervalued. So for us, that's a sweet spot right now. But at the end of the day, we are value investors, and we will go where assets are cheap. At the moment, global multinationals happen to be cheap, so that's where we're investing. But we start with a clean sheet of paper, and we have two criteria. They have to be undervalued, and they have to be good quality businesses.
Piet, can I ask you a question? What we've always discussed about value funds, and I assume that you will still call this a value fund with your own value approach, is that it should go down less than the market when the market goes down, and it should go up with the market at least. And I'm just looking very quickly at the graph since inception, and you've done very well to do less badly than the market when the market goes down, which I can understand because you were already in the cheap stocks. But I see that you've also done significantly better than the market on the upside. What has been the main cause behind that?
Well, I think when you're referring to doing significantly better than the market on the upside, that's over the past 2 or 3 years. And you remember that 3 years ago, we were basically at the trough of the global financial crisis. And at that time, the sort of companies we love investing in, the really good stuff, was fantastically cheap. And so we basically filled our boots with really good companies at fantastically low, almost once-in-a-generation type valuation levels. And I think that's helped us outperform the market over the past 2 or 3 years. And just recently, I don't know if you recall, but about 18 months ago, there was this big swing into the so-called BRICS. You know, everybody wanted to invest in Brazil, Russia, India, China, and South Africa. They were sort of the fad or the theme of the day. From our point of view, stocks in those geographies had become very expensive even 18 months ago. And we had no emerging market exposure. All our exposure was through global multinationals, and still is. And they happened to outperform quite strongly over the past 18 months. So I think there was a bit of luck involved over the past 18 months. But you know, if you go back to inception 6, 7 years ago, I think the pattern is well established. We do slightly less well than the market when it goes up, but do a lot better than the market when it goes down. And if you put those periods together, we tend to generate fairly acceptable returns over time.
Harmony Gold stands out for me as obviously the South African listed stock in your top 10 here. You're sitting with 3.3% in December 2010. You reduced that to 2.8% in terms of your top 10 holdings. Piet, Harmony Gold is still a big player in your book?
Look, we own Harmony Gold, we own 1 or 2 other smaller positions in gold shares, and we own some gold ETF as well. Gold for us is an insurance policy. It's the sort of thing you buy which you hope will not do well. When you take out a policy on your house, you hope that nothing will go wrong. And the same with gold for us. We actually hope Harmony does very badly as an investment. But if certain things happen going forward, then it will do very well. And that for us is insurance policy.
Pete, I've got both Vickers and Kevin giggling in the studio this evening. I know Kevin's coming back with a question on that front.
Pete, I look at the asset allocation. What you've got is an asset allocation in your fact sheet, and in it you've got an element of cash in the portfolio that on the fact sheet looks to be around about 20%. Give me some idea of what level of cash would you normally have? Is this normal? You were saying there have been quite a lot of investment opportunities. You found a number of value stocks. Where does cash fit in?
For us, cash is a hedge against bad things happening. So as assets get more expensive, we tend to own more cash. To just put that in perspective, in March of 2009, at the bottom of the financial crisis, we were just about fully invested. I think we had a 3 or 4% cash in the fund at that time. Since then, stocks have gone up a lot. Even the stocks we hold have gone up a lot. And we have somewhat reduced our positions in some of those stocks. We've added some new stocks in Europe and that sort of thing. But the net result of our actions over the past 18 months has been to reduce our exposure to equities. And as they get more expensive, we'll probably continue reducing that. But it's very important to bear in mind, this fund is an equity fund. It runs against an equity benchmark. And the cash is just a fallout of our bottom-up view on, are there lots of cheap stuff to buy? Now, 3 years ago, there was lots of cheap stuff to buy. Today, there's still quite a bit. I mean, we have over 80% equity, but there's not as much as 3 years ago. So it depends very much on the bottom-up opportunities that we find, how much cash we hold. It's not a top-down decision, asset allocation decision at all.